There's a little bit of concern in some areas. One thing's for sure, Tom, flows. This is the money going in and out have been simply titanic. Let me show you some figures here. Last week, there were record flows in bond funds across the board. So we saw, for example, record inflows into money market and government bonds. And we saw record outflows from investment grade and the second highest outflows coming from high yield. Now, Andrew, our fellow ETF buddy Chris Hempstead noted that LQD, that is the investment grade bond ETF from iShares, closed 4.5% below its fair value on Thursday. And the average premium is usually pretty tight. It's only about 6 basis points. Now, Andrew, I wonder what this tells us. Does it imply that the last prices of the underlying bonds aren't really reflecting the prices the bond market participants are willing to pay? What does this tell us? Walk us through this.
Point of what's happening. The stale pricing is the right word of the actual bonds. It doesn't reflect the depth of liquidity at that bond level. As we've always taught, and we've said many times on ETF Edge, an ETF's liquidity is really a function of the underlying liquidity of the asset class. And although there was bids seen on the market, in the bond markets, in the corporates, they weren't simply able to be actionable or able to have depth. So market makers were not able to accurately hedge. However, you were able to get risk. It's just a function of how much risk premium you're willing to pay.
Yeah.
A mutual fund you cannot get in and out of during the day, and these ETFs held up by giving people the right to sell if they wanted to. People that sold earlier in the day in those bonds, in those bond funds, just happened to time it correctly and get out before the discount evaporated.
So the point seems to be, Andrew, that it's who gets it right here? Did the ETFs price it right, or were the bonds a little bit behind what actually the public was willing to pay? I'm not trying to assign any blame or anything.
Right. There's no blame.
Are the ETFs pricing the market right, or are they getting it wrong?
Right. You're getting it right, but we're at max levels of uncertainty. And you have to give market makers a little credit for still willing to stand in there under these unprecedented times and make a market. They are just simply pricing in the premium to transfer the risk from one client onto their books. When uncertainty reaches its peak, which I believe we are getting closer to, and I don't mean the peak of a coronavirus and its effects, just we have some clarity economically on what it means for interest rates, some clarity on what it means for these companies, then market makers can more actively and calmly price markets.
Right.
Yeah,
and Tom,
Bob,
maybe a little bit
Tom,
of an
if I can
ETF.
jump in. Yeah, a couple quick things. Number one, 90% of ETF trades are natural trades from a buyer and a seller. The whole thing about 10% being creation redemption is really key and critical during these times. And as Andy was pointing out, the arbitrage instance here that keeps that spread really tight is important. But if the APs are buying these ETFs at a discount and going to market and don't think that they can make up that underlying, that's where the disconnect comes in. So it really comes down to the underlying pricing of the bonds. And with these mutual funds, they use pricing services that may be completely out of whack. It really comes down to what people will pay. And in this case, ETF pricing is right.